Hi, my name is Robert Perez, and I'm the Chief Investment Advisor here at E2I Financial Group. Today we're going to introduce you to one of our premier services that we provide mainly to friends, family, and colleagues of our top clients. We call it our Second Opinion service. What we do is take an unobstructed view of your portfolio and analyze it for risk. Now, we've been doing this for a number of years, and what we found is that most people have no idea what they own or how much risk they're really taking. They have what we call affectionately hope and prayer portfolios. They hope it does well, they pray it does well, but they really don't have any idea about why their strategy is destined to succeed or fail. Now, before we take any individual look at a portfolio, it helps to understand our firm's attitude towards risk, and this chart will help us do that. So we notice here that over the last 118 years, the Dow generally has trended up. But any investor who's been in the market for the last 15 years or so knows that the market does have periods of time which are quite dangerous to be in when we see these downturns. So if we take a closer look at the chart, especially in the years 2001 and 2008, we see that those years were very detrimental to investors' health. When we ask most of our prospective clients if we know that the market is going to have a downturn every 6 to 7 years, and we know that at around age 60, we're going to experience another 4 to 5 of these market corrections, the question then becomes, how many of these 30 to 40% drops can you take during your lifetime? And most of our clients answer, none. And we're of the same opinion. We just don't feel that as a retiree or a pre-retiree that you can afford any substantial loss nearing retirement. So how do we take this attitude of risk mitigation and actually put it into action? Well, we do it very simply by offering clients a 3-bucket approach to investing that lets them know exactly how much risk will be in their portfolio and lets them choose the exact amount of risk that they're comfortable with. So if we start with the bucket on the left, this is what we call our safe and secure option. Our safe and secure option has 3 distinct characteristics. The first is that it has no risk, meaning that you can never lose principal simply because the market turned down or had a drawdown. Secondly, it generally has 0 to very low fees, less than 1%. And finally, the expected returns average between 4.5% to 5% annually. And here's a snapshot of how it works. So you can see in the chart we have 2 different investment options. One is our safe and secure option represented by the green line. The other with the red line is a stock market option with high risk. Using the recession of 2001 and 2 as an example, we see that the safe and secure option in 1999 and 2000 didn't quite provide the returns of the stock market. However, when the recession actually occurred, the safe and secure option was flat, retaining all of its principal. Using the 2008 recession, we see that while the market collapsed at around 37%, the safe and secure option remained flat without losing any principal. Now, let's focus on our low-risk investment option. Our low-risk bucket is not without risk. You can lose money. However, the mandate of our carefully selected managers is first to be defensive in bad times, meaning their strategy is to go risk off to cash when the market is tumbling. And conversely, when the market's doing well, they're trying to be opportunistic to enhance returns. Let's take a look at how they perform. This chart shows the annual returns of our top managers net of a 2.75% annual fee. So we're looking at real numbers here. Let's focus on the 7-year returns because that will include the 2008 recession, so we know how they'll perform during bad times. The first manager we see has an 11.23% 7-year return. That's net. The next manager is 9.47, 10.9, 7.2. So you can see, while still being defensive, they're still able to achieve phenomenal results. For us, this chart shows where we earn our keep. Everybody knows that 2008 was a horrible year. Across the board, everyone got hammered. Our firm took a different approach. Rather than accept mediocrity, our firm chose to pick managers who had track records in 2008 that were flat or positive. So let's take a look at the numbers. In 2008, our top manager had an annual return of 4.71% net after a 2.75% annual fee. Our second manager had over 9.6% return. Our third was 11.3, 7.25 for our fourth. One of our other managers was flat, 20% for another manager, all while the average 60-40 portfolio lost almost 24%. For those in a 401k who had a higher equity weighting, most people know that in a 401k, people were losing closer to 30 and 40% for the year, all while our managers were either flat or made money, net after fees. So let's take a look at the moderate risk investment bucket. Like the low risk investment bucket, this too is not without risk. You can lose money. This bucket is for clients who are further out from retirement or who don't mind having a little bit of extra risk in the portfolio to enhance overall returns. So let's take a look at what we can expect. So once again, looking at our chart, these are real numbers, net of a 2.75% annual fee. So again, let's take a look at the 7-year returns because that will include the 2008 recession. So we see that our 7-year returns on our first manager is averaging 14.85%, 17% for the second, 14% for the third, 11.62 for the fourth, all while the S&P averaged 7.27% during the same time. Now, one of the key components of this chart that we like to refer to is what is called a max drawdown. A max drawdown is what investment advisors like to refer to as the maximum top to bottom loss that any investor can expect during a given time frame. So for instance, if we look at our top manager, we see that they had an 18.82% max drawdown during the last 7 years. Another one of our managers has a top to bottom drawdown of 19%. Another one was 13%. Another one was 11.62, 13.39. But it's all relative because the S&P had a max drawdown of 50.95%. So as you can see, our managers are taking a lot less risk than the S&P, but almost doubling the returns net after fees. So now you know our firm's position on risk and how we believe that taking less of it doesn't necessarily mean that you have to sacrifice returns. But this begs the question, how much risk is in your portfolio? Let's take a look.